The National Association for Consumer Advocates defines payday loans as short-term, high-interest loans, usually for small amounts like $500 or less, that are due your next payday. Often providing an ID with a pay stub or bank account information is enough to allow you to walk out with the requested amount of cash. With rising homeowners insurance premiums putting pressure on Floridians' pocketbooks, payday loans present themselves as deceptively good options to keep the bills paid on time and to handle an emergency. These quick payday cash advances come with some costs that are often more than people can shoulder, so it's important to understand how they work and the risks involved so that you can make an informed decision before signing the final paperwork. The Community Financial Services Association of America once estimated that there were 18,600 payday advance stores nationwide, extending about $38.5 billion in credit to 19 million households. The storefronts seem concentrated in low-income communities of color, and the Consumer Financial Protection Bureau found that in 2014, most of these loans were issued to consumers who renewed so many times they paid more in fees than the original loan principal. This doesn't even consider the emergence of online lenders. And these loans have high interest rates, and we're not talking about a credit card's 10 to 30% interest rate. The average interest rate for payday loans is 400% APR, and the usury statutes in most states provide exemptions to allow these lenders to continue their shady business practices. And there are also additional costs or finance charges associated with the loan beyond the interest rate. If you cannot repay the loan, additional fees and costs can begin to accrue. If you authorize the lender to automatically deduct payment from your bank account, you may now have overdraft fees with your banking institution. This is how an unaware consumer can find themselves caught in a debt spiral, borrowing more or paying round after round of fees until the loan is repaid. Debt.org provides the clearest example of these interest rates in action. In order to avoid discussing their triple-digit interest rates, payday lenders commonly advertise what they call a price per $100 fee, which is typically $15 to $20 for every $100 borrowed. And each time the loan rolls over, usually every 2 weeks, a new fee is added. At that pace, the amount owed on a $200 loan could soar to $500 in just 2 weeks, an annual interest rate of 391%. Payday lenders are known to be exceptionally aggressive when it comes to collections. If a borrower fails to repay the loan, the debt may be sold to a debt collector. These debt collectors often report delinquencies to the credit reporting agencies, resulting in damage to one's credit score. Those collection companies may then begin to call you or otherwise attempt to contact you to collect the debt. Now, while the allure of quick funds may still call to some consumers, the attorneys at Holland Law Group may have alternatives for you to consider before diving into the murky waters with the loan sharks. If you've been sued by a debt collector, our attorneys represent consumers from the tip of the Florida Panhandle to the coast of Key West. Holland Law Group can assist in negotiating a settlement on your behalf. Alternatively, if you have more delinquent accounts that are keeping you up at night beyond a late payday loan, a free consultation with our bankruptcy department may allow you to get the clean slate you need for your financial recovery. Don't let the financial pressure of the economy pull you down. Contact Holland Law Group for a free consultation. Call us at 941-744-5450 or visit us at hollandlaw.com today